Hey, everybody. Welcome to the morning market briefing Thursday, June 16th, 2022. Hope you're doing well. As a quick reminder, tomorrow's episode is all Q&A. If you have questions about the market, about what's going on, how we're positioning portfolios, what we're expecting, what's happened, all of that kind of stuff, please send your questions to me, Hall, Ahall, at narwhalcapital.com. And we will answer those questions on the air tomorrow. So all Q&A tomorrow. As we're sitting here right now, Dow futures down 1.6%, S&P futures down 2%, NASDAQ futures down 2.3%, oil down just a little bit, certainly retracing the progress that was made into the afternoon yesterday, which we will come back to here momentarily. But Ben, we are waiting on some economic data. We've been talking a lot about the job situation a couple months ago. We kind of highlighted initial jobless claims as something to start keeping an eye on as we see interest rates going up, as we see the odds of recession going up, as we see companies cutting expectations. Typically, layoffs and things of the like come with that. We've heard a lot in the news of specific companies doing that, but kind of waiting on that economic data to come through a little bit. The estimate for initial jobless claims this morning is 217,000. Last week we came at 229,000. What are we seeing? Do we have that number yet?
So I'm waiting on that number. But we do have housing starts. Housing starts were down 14.5% to a 1.5 million seasonally adjusted annualized rate. That was versus a consensus of just down 3%. So a big miss on housing starts. Basically, what a lot of companies are doing is that they're just waiting on a lot of that stuff to actually build the houses. They don't have a good idea of demand, so they're not building houses right now. We do have the jobless claims number. It came in at 229,000, but the week before was revised up to 232,000. So we're beginning to see that average tick up. We haven't seen that big spike yet. But again, so this is not this last week, it's the week before. I anticipate that we're going to continue to see higher movements in this number over time. I don't know how high, but we were talking about it this morning. I think that this is one of those things that you'll probably, if you came back in a month, we'd be talking about 300,000. And you said, man, where did those initial jobless claims go? We were at 200,000 a month ago. But when you see it on a weekly basis, some of those gradations are difficult to ascertain. The point here, though, is the moving average has begun to at least flatline and begin to tick up. And this is reflective of what we're seeing on the anecdotal side, too.
Yeah, and we'll come back to kind of Fed expectations on the economy. I think there's some misplaced confidence in some of those numbers. We do have Adobe reporting earnings this evening. We also have the Bank of Japan meeting tonight. Ben, anything you're really looking for at a headline level?
On Adobe, I am concerned. They do have some marketing businesses as well as their, photo editing and video editing. If you start losing some of the advertisers, a lot of the edits go into advertising products. You start losing that advertising demand. You start laying off advertisers. You don't need as many subscriptions. So that could hurt Adobe's growth this quarter. I'm interested to see where it ends up going. Right now, just tech in general is a tough place to be.
Yeah, I would agree. We've got a bunch of interesting stories, some not even here in the U.S., but Gazprom, big producer of gas, has said that they are halting exports due to technical issues. Today, they say the gas supply cuts are a result of issues with turbines due to sanctions. Cuts are not done on purpose. The Germans, meanwhile, think it's politically motivated. We've got a fire at an LNG export terminal here in the U.S. It's going to be tough for Europe.
It's going to be
bottom line.
It's going to be really tough for Europe. European natural gas is up 24%. So conveniently, what did the Russians just do? Well, about 15 minutes ago, after slowing gas through the Nord Stream 1 pipeline, that Nord Stream 2 pipeline, which was built but not certified, they said, you know what, we can start immediately supplying Germany with gas through Nord Stream 2. So basically, they're saying they're using all the leverage in the world. They have all the cards. They are saying, we're not going to give you gas through this pipeline, but you got to certify this other pipeline and get this going so that we can sell to you at a higher natural gas price more gas. And the Germans don't really have anything to do because they can't really do anything because so much of their plan to wean themselves off Russian natural gas was to stockpile natural gas during the summer so they can prepare for the winter. But now Russians have slowed that gas and said, you got to either pay up, certify, or get ready for a very, very cold winter.
There we go. Swiss National Bank, meanwhile, kind of jumping on board with some interest rate increases. First increase in 15 years, pretty wild. They moved up 50 basis points, Ben, but they're still at negative 25 basis points on their borrowing rate. Relatively sizable move. I think some were surprised by this. You weren't. Why not?
Yeah, I mean, this is why we were talking about this, why it was in that note that we sent out on Friday. Usually we wouldn't put a Swiss National Bank note as something to watch in the week ahead. But, I think it was put in there for a reason. And one of the reasons is we thought that they might do something like this. It's strengthening today. I wouldn't read too much into it other than saying, I do think that the Swiss are a little bit more in control of things. They only have to worry about one country, one geography. They have a fiscal policy. They have their own monetary policy. They're not hostage to the European Central Bank. They're not hostage to the European Union. And I think that they are going to do the right thing. And that's what they did this morning.
Yeah, I mean, the ECB is kind of a mess, which we'll touch on a little bit. Bank of England also raising rates. I mean, Ben, this seems like a pretty pronounced trend that we're going to continue to see. I continue to think, I was talking with a client earlier this week, I kind of think just as America has kind of led the COVID recovery from an economic standpoint, I think we're a little bit ahead of the game relative to other countries around the world. I mean, would you agree with that assessment? I think everybody's going to face some of these issues if they are not already, but we're as slow as we've acted. I think we're acting faster.
I think that we were behind.
Yep.
We were behind Bank of England, certainly. Bank of England was probably the first mover on this, but they've been doing 25 basis point increments. Part of that is because they started earlier than we did. But we certainly have been ahead of the European Central Bank, certainly ahead of the Swiss National Bank. And right now we have rates at 175. And the Bank of England, even after this raise this morning, is at 125. They did suggest that they could go faster in future months.
The ECB is planning on rolling out a new tool, a way to try to address some of the fragmentation they're seeing in their economy. What's this going to look like, and is it going to accomplish anything? I mean, as hard of a job as the Fed has right now, the ECB trying to represent every constituent across all those countries is really between a rock and a hard place, I feel.
Yeah, I think what it's going to end up looking like is they'll probably still continue to reduce the size of their balance sheet by selling bonds. But I do think it'll be partially offset by buying bonds of these fragmented countries. So what that could look like is they could sell German bonds, buy Italian bonds, something like that. In the US, what we did back in 2012, I think it was this thing called Operation Twist. And in this operation, basically, we were trying to reduce the borrowing costs if you wanted to have long-term certainty. So what we did was we sold short-term rates and bought on the long end to take those long end rates down so you could have cheaper mortgages and that sort of thing. So I think you're going to have a similar thing that happens in Europe, but instead of different maturities and targeting different points on the interest rate curve, actually targeting different countries. Now, if I'm a German person, I'm pretty upset with this because I don't want my borrowing costs to go up because the profligate Italians, because then you're basically subsidizing Italians' borrowing costs, which the Germans don't tend to like to do.
Yeah, I don't blame them either. Let's get to the big story of the Fed. 75 basis point increase, which was all but baked into the cake by the time the announcement was made. No surprise there. What's interesting to me is their economic forecast. They come out and they kind of say, hey, here's what we expect GDP to look like for the year. Also looking out to 23 and 24, unemployment rate, kind of core inflation, Fed funds rate, all of that. I still continue to have concern that their narrative just does not match what will likely be reality. I think they're very, very low on their expectation for unemployment. They have that marked at 3.7% by year end. going slightly up to 3.9 in 23 and 4.1 in 24. The 24 number may end up being kind of right. I just think they're incredibly low on 2022 and 2023. I think they're still way off on inflation. I think they're way too optimistic on GDP. What are your thoughts?
Yeah, I think the GDP one is so. For perspective, the Fed doesn't really know what it's talking about, because in December they projected that GDP in 2022 would grow 4%, and now they're expecting 1.7%.
And four is a great year.
Four is a great year. 1.7 is probably a subpar year, but kind of muddle along. I think what they said is that so they expect about 14 rate hikes this year, taking the rates up to 3.4% at year end, which is broadly in line with what the market was anticipating. But they did say that they could do more or less depending on where inflation is. I think what's interesting here is that I did read this as dovish, because if I'm looking at the pace of Fed funds rates before the call, before the announcement, I was thinking 3.75% was kind of the bogey. Anything less than 3.5 would be a little bit dovish. Anything more than 3.75 would be hawkish. They came in at 3.4 for the year, so a little bit dovish on that side, because it's between 6 and 7 rate hikes additional, taking the full year total up to 13, 14. Here's what I'm concerned about by the Fed, is that they are pleading the fifth on some things. So they noted in the press release, for example, inflation remains elevated, reflecting, number one, supply and demand imbalances related to the pandemic, number two, higher energy prices, and number three, broader price pressures. So number one and two, and the order on this is significant. The Fed thinks about this. Number one, supply and demand imbalances. The Fed would say, well, we can't do anything with that. Number two, higher energy prices. They said, and they even said in the press conference, we can't do anything about it. And then number three is broader price pressures. And so basically he's saying we can't do anything. And even they deleted this sentence from the prior announcement that said, with appropriate firming in the stance of monetary policy, the committee expects inflation to return to its 2% objective and the labor market to remain strong. They deleted that sentence because they said it implied that monetary policy could alone do this. And they said that is not true. And so essentially what they're doing is they're saying, not my problem. We're going to raise rates, but we're not going to, if we don't achieve our goals, it's not our fault. It's not the fault of monetary policy. So I think that's incredibly significant. I also think it's significant separately that they still see strength in the economy. And if they're this dovish now, how much more dovish are they going to be when that unemployment rate hits 5%? Now, we're not even talking 8%. But right now they expect it to be 3.7% at the end of the year. I don't think there's any way that it's only 3%.
No, and I think, there's no better example of kind of the talking out of both sides of their mouth than when they're talking about GDP. They throw out this GDP number. They talked kind of broadly about risks of recession, things like that. And yet the Fed now data from the Atlanta Fed suggests that the GDP expectation for this quarter is 0, and it's been significantly trending towards downgrades. It's only a matter of time before that, I think, is projected to be negative. And yet they kind of just ignore that. They talk about the favorable trends they're seeing economically, things like that. I agree with them where they can't only fix this if there's a supply and demand imbalance. We've talked about this repeatedly, but if there's a supply and demand imbalance, raising interest rates is not necessarily going to help supply. And that is part of the problem. So I agree with them, but it does seem like the buck is kind of being passed.
The problem is, so we're transitioning a little bit to the economy, and his analysis of this, he said that, quote, the consumer is in really good shape financially, they're spending, and then importantly, there's no sign of a broader slowdown that I can see in the economy.
He's just not looking.
Is the guy an idiot, or is he just lying to people? Because, everywhere I look, there's signs of slowdown in the economy.
There's signs, there's data, there's guidance cuts. They're slowing spending. Like there's so many data points here that are suggesting, even if you don't go out in the world, even if you just said, hey, I go to my office, that's the only place I go, I don't interact with people anywhere. Even if that were the case, you have all this data.
Yep. And I think the ultimate implication of all this is that the Fed is more dovish than we expected now. But the board they're playing with, whatever board it is that they're playing on, where they're being a little bit more dovish than expected, they're playing on the wrong board. If they shift that board to what is reality,
yep,
and they're already dovish, I mean, how much more dovish are they going to be? And so for that reason, I actually thought that what the Fed did yesterday, the reaction made a ton of sense initially. We were talking about if the Fed was hawkish, the market may fall initially. I think by the end of the week, it probably would be good. And
we got the opposite.
We got the exact opposite. The market gave the Fed, excuse me, gave the market another infusion of drugs, gave them some morphine, market ran up. And then I think people realize today, inflation is only being perpetuated now by the Fed. And for that reason, risk assets are all selling off.
Yeah, they're selling off tremendously. Again, futures down kind of that 1.5 to 2% range. It's hard to, I think the statement they made that I most consistently agree with probably is this quote right here: the worst mistake we could make would be to fail. I agree. I think everybody agrees, but that rings a little bit hollow after kind of giving all the reasons why they may not be able to win.
Yep.
It's a tough spot. I mean, I don't envy their position. I do think they've put themselves in this position. I completely agree that there are some things beyond the control of them. Logan had a great quote. I don't think he realized it when we were talking the other day on the podcast. He said, we need to get back to letting the economy be the economy. That is part of it. My hope is that maybe through this, we get a little bit less reliant on monetary policy and we get a little bit more hands off. I hope that's a takeaway from this, because I don't think they can just pull us out of it, but it does seem like they're kind of tone deaf.
Yeah, I mean, really the idolatry of central banks and central planning over the last 15 years has just continued to ramp up. And I think we're seeing the consequences of it right now, because these edifices are crumbling. And we're showing, I mean, today, even the 2-year is selling off incredibly. Interest rates on the 2-year note are up, I think 20 basis points or something like that. Massive sell-off there, basically saying the Fed doesn't know what it's talking about, and they're not doing nearly enough to control inflation. Even the inflation they can control, they're not doing enough about, let alone the inflation they can't control. And you still have actors like Putin still pulling the strings on gas. I mean, natural gas prices up 24% in Europe, and then kind of just playing around with stuff. Now, I would say oil prices are down today, which might have some relief and maybe good for the economy. But I do think that's a relatively short-term thing. And if we continue to just be too dovish here, I just don't think there's much relief in cards for inflation.
Yeah, I agree. We'll wrap it up there. Tomorrow, Q&A. Send your questions to ahall@narwhalcapital.com. Looking forward to having a different thing in terms of content. I will also note that Monday there is no call. The market is closed. So you guys can get a break from us, and we'll talk to you guys tomorrow morning.